Welcome to The Deep Dive. We're your go-to for breaking down the really important earnings calls.
Getting right into the details.
Today, we're diving into Jackson Financial Inc. That's ticker JXN. We're looking at their Q2 2025 results.
Yeah.
Our mission for you today, well, it's simple. Cut through all the noise, pull out the most important insights, and really give you a solid understanding of what's actually driving this company.
Get ready for a focused chat. We'll deliver those key takeaways from their latest performance.
Okay.
So we've reviewed the latest from Jackson, and we can tell you their second quarter was really marked by some strong operational execution.
Okay.
And a confident outlook, too, which, the market reacted very positively to.
Right. We saw that jump.
We did. We'll unpack exactly why that was the case.
All right, let's get straight to the numbers then, because they painted a pretty compelling picture, didn't they?
They certainly did.
Jackson reported an adjusted earnings per share, that's EPS, of $4.87.
Mm-hmm.
Now, that wasn't just a beat. It significantly outpaced analyst estimates.
By $1.26. Yeah, a solid 5.6% beat.
A solid beat indeed.
And while revenue came in at $1.75 billion, which was a slight miss, just 0.4% off estimates.
Okay, slight miss there.
And down 37% year over year,
Mm-hmm.
that figure was, frankly, largely overshadowed by the strong underlying metrics.
Right. You got to look deeper sometimes.
Exactly.
So free cash flow for the quarter stood at $290 million.
Pretty strong.
Yeah, contributing to over $1 billion on a trailing 12-month basis. That's significant.
Absolutely.
And their risk-based capital ratio, the RBC ratio, stayed robust at 566%.
Which is way, way above their 425% target minimum. Huge buffer.
Huge buffer, yeah. Shows real financial strength.
And this strong capital position, well, it directly translated into shareholder value, didn't it?
Seems like it. How much are we talking?
Jackson returned $216 million to common shareholders just in Q2.
Wow.
Through buybacks and dividends.
Mm.
And get this, it marks their 15th consecutive quarter of capital returns.
15 straight quarters. That's consistency.
And it's showing a 60% increase year over year on a per diluted share basis.
Yeah.
Massive jump.
Okay, so they're really leaning into returning value. What about sales?
Sales look good too. Retail annuity sales grew 4% year over year to $4.4 billion.
Okay.
And the registered index-linked annuity sales, the RILAs, they're approaching $1.4 billion.
That's a big chunk.
It is. Represents nearly 1/3 of total retail annuity sales now. And showing strong sequential growth too.
Okay, so that RILA segment is really heating up for them.
Definitely a key driver. Now, what's truly fascinating here, I think, is Jackson's consistent earn it then pay it philosophy for capital returns.
Right. Earn it, then pay it. Explain that a bit.
Well, it's this disciplined strategy, really. It rests on three pillars.
Mm-hmm.
First, you generate the free capital internally.
Okay. Makes sense.
Second, you turn that into actual free cash flow.
Right.
And third, then you return that capital to the common shareholders. It's about sustainability.
I see. So it's not just borrowing to buy back shares or something.
Exactly. It's organic.
And the numbers, they seem to back this up.
Clearly demonstrated. They've already generated $665 million in free capital just in the first half of the year.
Wow, halfway through.
Yeah, tracking well above their $1 billion plus full year expectation. And the company is highly confident they'll meet or even exceed their 2025 capital return target.
Which was, what, $700 to $800 million?
$700 to $800 million, yeah. They're feeling good about hitting the high end or more.
That's strong guidance.
And their holding company cash position, over $700 million, further underscores their financial flexibility.
Gives them options.
Right. Supports sustained capital returns well beyond 2025. And this disciplined approach, coupled with the share buybacks, drove a 3% increase in book value per diluted share.
Up to over $15,500.
Exactly, for the first half. Even though the total adjusted book value dipped slightly because of the buybacks.
So the pie shrank a tiny bit, but each remaining slice got bigger.
Precisely. It highlights how they're using capital to enhance value for the individual shareholder. Very effective.
Okay, let's shift gears to products. Jackson is clearly leaning into evolving market demands.
No doubt.
We mentioned the RLA momentum, right? Accounting for a big chunk of sales now.
A huge chunk.
And they've launched new RLA products too, MarketLink Pro 3 and MarketLink Pro Advisory 3rd.
Mm-hmm.
What's interesting here is they offer a NASDAQ 100 index option and full principal protection. That sounds appealing.
It really does, especially in uncertain markets. And this raises an important question. How does that 100% principal protection affect their capital efficiency?
Yeah. Does it tie up more capital?
Well, Management confirmed that despite this feature, the new RILA product remains very capital light.
Okay, so they found a way to offer protection without breaking the bank, capital-wise.
Seems so. And furthermore, Jackson is broadening its income-oriented product shelf. They launched Jackson Income Assurance.
Okay, what is that?
It's a new fixed index annuity, an FIA, and it features an embedded guaranteed minimum withdrawal benefit, or GMWB.
So targeting that guaranteed income stream market.
Exactly, diversifying their offerings.
They're also making strategic investments in technology, right? Like a new digital experience for financial pros.
Yeah, that's important too. It's not just about flashy tech.
No, it sounds like it aims to better align client needs with the product benefit.
Right, and facilitate new advisor relationships. It shows a commitment to enhancing their distribution channels. Can't neglect those.
Very true. Crucial for long-term growth.
Now, a really crucial aspect of Jackson's stability, and maybe a core competency, is their sophisticated risk management.
You mean the hedging program?
Exactly.
Yeah.
Despite market volatility in Q2, and their hedging program delivered a consolidated net hedge gain of $61 million.
A gain in volatile times. That's impressive.
It really is. And it's a testament to their shift to a more economic hedging approach back in 2024.
So this new approach is paying off. How does it work generally?
Well, it significantly improves the stability of their non-operating results.
Yeah.
Makes them less jumpy. And it contributes to more consistent capital generation. Plus, their program benefits from this robust stream of guarantee benefit fees.
Right. You mentioned those are assessed on the benefit base, not the account value.
Precisely. Which means they get consistent fee generation even if the market dips and account values fall. It's a smart structure.
Okay, connecting the dots here. Brooke Re, their reinsurance vehicle, plays a big role.
Absolutely key. Think of Brooke Re as like Jackson's specialized internal shock absorber.
Okay, I like that analogy.
It lets them hedge much more closely to the actual economics of their variable annuity business.
So it makes their capital position and that RBC ratio less sensitive to the stock market going up or down.
Exactly. Less sensitive to equity movements. And the bottom line is a more predictable and stable capital generation profile. It's a fundamental de-risking move.
Got it. And it's worth noting, they manage the variable annuity and RILA businesses separately, right?
She do.
Yeah.
Even though there's a sort of natural equity risk offset between the two products.
Also?
Well, variable annuities often have downside risk if markets fall, while RILAs can offer buffered protection or upside potential. But Jackson keeps them distinct for risk management.
Okay, so all the guarantees for the variable annuity business get reinsured to Brooke Re.
Correct. While the RILA business stays directly with Jackson, it allows for very precise management of each risk profile.
Makes sense.
And we also saw some encouraging improvements in variable annuity net outflows.
Oh, yeah. What happened there?
They improved by about $900 million compared to Q1 2025, basically getting back to the level seen in 2023.
What's driving that improvement?
It seems to be a combination of things. Declining surrender rates, lower benefit payout rates, plus positive separate account performance from the market, and just increasing sales diversification into products like RILAs.
So stabilizing that older block of business while growing the new stuff.
That seems to be the strategy, yes.
Okay, looking ahead. Management talked about strategic M&A, mergers and acquisitions.
We did. Indicated an openness to M&A or risk transfer opportunities.
But with the caveat, right?
Always. Always. Through the lens of creating new streams of capital generation and enhancing shareholder value. They're not just chasing deals.
So disciplined growth.
Right. And what's really fascinating here is their exploration of using Brooke Re, that reinsurer, for inorganic growth.
How would that work?
Like potentially acquiring other variable annuity companies and putting their risk into Brooke Re.
Leveraging their existing structure.
Exactly. They're also considering setting up new affiliated reinsurers or captives separate from Brooke Re.
For what purpose?
To manage capital usage, specifically for spread products like fixed and fixed index annuities, potentially doing this both domestically and offshore.
Wow, that's getting pretty sophisticated on the capital management side.
Very sophisticated.
Yeah.
Optimizing capital across all product lines.
And their asset manager, PPM America, is also playing a role.
Yeah, strategically allocating new money into higher yielding asset classes. Things like emerging markets debt, residential home mortgages, investment-grade structured securities, trying to boost returns for those spread products.
But are they taking on a lot more risk to get those yields?
It appears not excessively. The company's investment portfolio overall remains high quality. Very low exposure to, say, commercial office loans or below investment grade stuff.
Okay, so seeking yield, but staying conservative overall. A balancing act.
It seems so. A disciplined approach even while seeking higher yields.
Okay, let's pivot. What does this all mean for you, the investor listening in?
Well, the market's reaction tells a big part of the story, doesn't it?
It certainly seemed positive. The stock closed up over 7% on the earnings call day.
Right. And it wasn't just a one-day pop. It's continued to show strong momentum since then. The market clearly liked what it heard.
And that confirms a pretty bullish sentiment.
Definitely. And if you look at performance over the last 1 and 3 months, Jackson Financial has significantly outpaced both the S&P 500 and the iShares U.S. Insurance ETF.
So strong relative performance too.
Very strong. Driven by that robust capital generation, the aggressive capital return program we talked about, and that positive momentum in RILA sales.
And those factors clearly overshadowed the slight revenue miss and maybe some year-over-year fee income pressure.
Absolutely. And also what management called the noisy gap revenue optics.
Right. The accounting stuff that can make revenue look volatile sometimes.
Exactly. The market looked past that noise and focused on the underlying cash generation and statutory capital, because that's what really fuels the buybacks and dividends.
That makes sense. Focus on the cash.
Always.
And the broader industry context looks pretty good too, right? Annuity sales are up.
Very supportive. U.S. annuity sales actually hit record highs in the first half of 2025.
Record highs. Wow.
Yeah, and RLA products specifically set quarterly records. So Jackson's strategic focus aligns perfectly with where the market demand is surging.
Strong tailwinds then.
Absolutely. And management reaffirmed their 2025 targets, signaling continued confidence. That's always a good sign.
So despite maybe some complex accounting, the market keyed in on cash, capital returns, and growth in the right areas.
That's the narrative the market bought into, yes.
Yeah.
And it seems justified based on the execution.
All right, let's get into our favorite part, the This Is Not Financial Advice segment.
Let's brainstorm some outrageous but plausible ideas.
Yeah, let's do it. We're seeing what looks like a fundamental disconnect maybe between their robust capital position and their current valuation compared to some peers.
Okay, my first thought for you. What about a long position in JXN, but maybe overlaying it with a short-dated, out-of-the-money call option?
Okay, unpack that. Long stock, sell a call against it, covered call-ish.
Sort of, but maybe selling a slightly higher strike.
Right.
The core idea is straightforward. Management is executing flawlessly on capital return. They've already returned $447 million in 6 months.
Against that $700 to $800 million target.
Right. And the CSO explicitly said they're highly confident hitting at or above the high end. This just screams continued aggressive buyback.
Which supports the stock price.
Exactly. Provides a strong floor, direct EPS accretion.
Yeah.
The out-of-the-money call, maybe, say, 30, 45 days out, strike 5-7% above the current price.
What does that do?
It aims to capture potential extra upside from any further positive news. Think an announced acceleration of buybacks, maybe a special dividend, or just continued strong RLA numbers feeding positive sentiment.
So you collect a small premium, limiting upside slightly, but betting on the core buyback story.
Yeah, the cost of that call option you sell is relatively low premium income, but the main bet is on the market continuing to recognize Jackson's capital return story. It's a way to maybe juice the return slightly on the core long thesis.
Interesting. Okay, my turn. Building on management's openness to M&A and risk transfer, what about a small, speculative long straddle on JXN, but maybe longer dated, say 6-9 months out?
A straddle, buying both a call and a put, betting on volatility.
Exactly. Betting on a big move, either way. Management explicitly talked about using Brook Re for inorganic growth, maybe buying VA companies or setting up new captives.
Right, signaling potential transformative M&A.
So a straddle profits if the stock moves significantly, up or down. If Jackson announces a large accretive deal that the market loves, diversifying them or de-risking.
The call option part pays off. Stock could surge.
Right. But conversely, if they announce a big deal that's maybe capital intensive, raises integration fears, causes short-term dilution.
The market might hate it initially. Stock drops. The put option pays off.
Exactly. Their strong capital position gives them the ammo, the dry powder, to make a bold move plausible.
So the straddle isn't betting on the direction of the reaction to a deal, but the magnitude of the reaction.
Precisely. It's a bet on the strategic optionality they've laid out and the market having a strong opinion about whatever they choose to do. It's definitely speculative, though.
Very speculative, but captures that uncertainty around a potential big strategic shift.
Interesting.
Okay, wrapping things up. Jackson Financial Inc.'s Q2 2025 earnings call really showcased a company in a remarkably strong capital position.
Deeply committed to shareholder returns, absolutely, and innovating within a pretty supportive annuity market right now. Key highlights for me were that adjusted EPS beat, the robust free cash flow, that super high RBC ratio.
And the significant, consistent capital returned to shareholders.
Yeah.
Can't forget that. The strong market reaction just validates the strategy.
Especially that focus on capital generation, the RILA growth, and that effective risk management through Brook Re.
Seems like a well-oiled machine right now.
So looking ahead, you'll definitely want to keep watching the execution on buybacks and dividends.
Yep. And the trajectory of those RILA and FIA sales. See if that momentum continues.
And definitely keep an ear out for any further news or disclosures regarding strategic risk transfer or M&A. That could be a real catalyst.
Definitely. Which leads to a final thought, maybe. What untapped potential still lies in Jackson's earn it, then pay it model? And how might future strategic moves, like those specialized captives they hinted at for spread products, how might that reshape the annuity landscape and potentially deliver some outsized shareholder value?
That is a really good question to ponder. Lots of potential levers they could still pull.
Food for thought.
Absolutely. And remember, everyone, the information shared in this deep dive, including those wild trade ideas, it's all for discussion purposes only.
Definitely not financial advice.
Investing involves risks. You should always consult with a qualified financial professional before making any investment decisions.
Absolutely. Well, thank you for joining us on the deep dive.
We invite you to share your thoughts and feedback.
Until next time.